A very warm welcome to this ELI Members Day celebration. My name is Pascal Pichonnat, and as president of the European Law Institute, it is my pleasure and my honor to greet you all to this webinar celebrating the ELI Members Day. Indeed, the European Law Institute was founded on the 1st June 2011, 13 years ago, during a large congress which took place in Paris. Last year, we decided to celebrate each year this foundational moment through a webinar gathering ELI members together outside the traditional annual conference assembly, which will take place this year in Dublin from 9 to 11 October. Important achievements in the last few months include strengthen our role as a key contributor to legal development and reform in Europe by submitting, among other aspects, two significant public consultations to the European Commission, including in the field of consumer contract law. We also hosted nearly 30 webinars since January last year, addressing some of the most pressing topics of our time, with high-ranking representatives from key stakeholders in their respective fields: European Commission, DG Just, DG Connect, Council of Europe, Venice Commission, EPPO, etc., etc. In 2023, ELI has completed 6 projects, and translations by our hubs have supported the task of further disseminating our outputs. In terms of dissemination, the ELI UNIDROIT Model European Rules of Civil Procedure conference of last February is also noteworthy, as it underscored the ongoing importance and impact of these model rules, and which have had since their publication in 2021. To celebrate our members and their innovative capacities, we chose for the ELI Members Day to focus on important developments of the future and reflect on them without limits. Last year, we discussed legal issues related to the metaverse. We were pleased to see that a couple of months later, the EU Commission published its EU initiatives on Web 4.0 and virtual worlds. This year, we decided to tackle the future of money. From barter to money, from coins to paper money, from credit cards to cryptocurrencies, money has always been at the heart of our economies. From centralized coinage guaranteed by gold to decentralized cryptos based on decentralized trust, the meaning of money has evolved and may face new challenges, with more than 100 central banks exploring whether and how to establish central bank digital currency, the so-called CBDC, and a growing number of stablecoins. And of course, cryptocurrencies. I checked today on CoinMarketCap, there were more than 10,000 cryptocurrencies with, of course, a relatively high volatility. With our fantastic panelists of today, we will investigate the challenges we will face, both on the regulatory level and policies, and on the implementation level of cryptocurrencies, such as the digital euro, but also what are the challenges brought by the predominance of Bitcoins and Ethereum in hands of private actors for the future of money. How to ensure some stability in a system based on trust, where volatility is high, decentralization makes it difficult to monitor and regulate, and where the market is transnational by essence. We will also reflect on whether there is or should be a constitutional right to pay in cash as an expression of freedom to choose the mode of payment and guarantee of financial inclusion. As always, you will be able to ask questions through the Q&A function, and our panelists will then answer those after a first round of presentations. And therefore, let's start immediately with our first panelist. Hubert de Vauplane holds a PhD from the University of Paris 2 Panthéon-Assas, and after working as a legal director at BNP Paribas, CIB, and Group General Counsel of Crédit Agricole, he joined Kramer Lewin LLP in Paris in 2011 as head of the regulatory and fintech practice. After 18 years as a professor of business and banking law at the University of Paris 2 Panthéon-Assas, he is now teaching international banking law at the Sciences Po Paris Law School since 2012. He is or has been an expert for the World Bank, the AMF, the European Commission, and the European Central Bank. He is also and was a member of various industry think tanks, such as the Financial Market Law Committee and further committees. He writes in various legal newspapers and wrote various books, in particular, its book on droit des marchés financiers, awarded by the Académie des sciences morales et politiques a wonderful prize in 1999. And therefore, I'm really thrilled to hand over to him to hear about evolution of the concept of money. Mr. de Vauplan, you have the floor. You have to unmute yourself.
Voila, is it better with you can you hear me now, Mr.
Perfect.
Chairman?
Thank you. Yeah, thank you.
Okay, thank you. Can you see my screen too?
Yes, we can.
Okay, excellent. Thank you for kind words. Difficult to summarize in 5 minutes the concept of money, specifically because I will do this presentation on behalf of Professor Francesco Martucci, who chairs the working group of the Haut Comité Juridique de la Place de Paris. The Haut Comité Juridique de la Place de Paris is a think tank sponsored by various French authorities as the Bank of France, notably, but not only. And this Haut Comité has been asked by one of the sponsors, in fact, the Bank of France, to prepare a report on the legal definition of money. I will more give you questions, as usual, and maybe less answers, because in 5 minutes it is quite difficult. Again, you can see part of the work of the Haut Comité Juridique during the last months, specifically on fintech, on crypto, with various reports on DEO, on international private law concerning crypto assets and digitalized securities, and the same for MiCA, and so on and so on. And all of those reports are available on the Haut Comité Juridique de Place website, both in French and in English, if you want to read it, if I may. Alors, this is now the most difficult aspect of my presentation, is to try to summarize, or at least to give you some ideas on the concept of money. Monetary law has been dominated by two approaches. On the one hand, a statist or nominalist theory, where trust derives from the issuance of money by the public authorities, and on the other hand, a sociological theory, where trust is produced by the use of money in the society. And this dual approach is now being challenged by the technology and the digitization, not only for the economy, but also for the different representation of the use case of money. And this need for clarification in both national and European law. As we will see in a few moments, there is no national definition of money in French law. And the issues discussed in the French law by the Haut Comité working group can, in my view, just easily be discussed in other jurisdictions in the EU. National law, EU law. Maybe concerning EU law, we can see significant changes in the recent years. On the one hand, in 2021, the EU Court of Justice, for the first time, as you know, defines the notion of legal tender for the euro. And this definition is largely taken up by the Commission in the draft regulation for the digital euro. On the other hand, the legal concept of money has been overturned by the advent of digital technology. And all of you know the 2015 case law in VAT dispute by the Court of Justice, again, describe Bitcoin as a virtual currency, while the EU legislator introduced in two directives the notion of virtual currency, then digital means of exchange, as opposed to legal tender or legally established currency. And this latter definition refers not only to euro bills and coins, but also to electronic money, which is an hybrid concept in itself. And as you know, the reform of the Payment Service Directive and the e-money directive as well as the publication of the MiCA regulation on crypto assets, which includes e-money tokens, have renewed the debate, but only made it more complex. Not to mention the emergence under the MiCA regulation of stablecoin or digital euro project. And if I come now to the evolution of the French law, I will not give you all the aspect of the current discussion at the Haut Comité. As I said before, there is no legal definition in the French law. There is somewhere, it is the first article of the French Monetary and Financial Code, which says that the French currency, the monetary of the French Republic is the euro, nothing else. And as you can see, there is other examples where there is some reference to the money, but here the difficulty is the absence of definition because there is polysemy of the type of money. Alors, if I go to the next slide, why there is such kind of polysemy of money? Because we are using different kind of words: currency, cash, means of payment, funds, as you can see in the slide. Most of all of them are somewhere not described, but used in various texts, regulation, or directive, both in the French and EU text. And the purpose of the report of the Haut Comité is to try to give clarification on the legal definition of the concept associated with money and to match them with resulting regime. Because as you know, if it does exist economic definition of legal money, it doesn't exist, at least under the French law, legal definition of money. The report should be published in for the end of the year, and it will come to some discussion or some question. I will not focus, but I will just share with you some of those questions. For instance, the concept of the legal tender to banknotes and claims and to other documents, or the distinction, if any, with the cours de la monnaie and cotation de la monnaie, which is not the same. Or again, the concept of claim or liability concerning banknotes, coins, and digital euro. Are we talking for claim or liability? The role of monetary authorities in electronic money. What else again? The concept of the legal consequences of tokenized deposit and the form of the digital euro, token-based or account-based, and the legal consequences. All those points will be discussed on this report concerning the French aspect of the legal definition of money. To conclude, a few words on what happens in international organization. As you know, as of today, there is at least 2 international organizations which are focusing on the concept of legal money. The first one is UNIDROIT, because as you know, in May 2023, UNIDROIT adopted the principles on digital assets in private law, and the principle contained recommendation to national legislator on how to deal with private law issues raised by the digital assets, such as cryptocurrency or token, including CBDC. And this is for UNIDROIT, where, as you know, we have now other international organization, which is the HCCH, the Hague Convention, where the Council of the General Affairs and Policy on 2023 mandated the Permanent Bureau to study the private international law implication of CBDCs. For instance, as an issue to be raised by the HCCH, the legal nature of CBDC might pose challenges to applying conventional private international law. And if you go to this aspect, for example, if a CBDC is classified as a tangible, intangible hybrid under a domestic legal framework, the lex felicitae could in theory apply, but it is unclear what is the status of a token held or on distributed register and through wallets would be. And to support its circulation as money, it will also be crucial and that private law rules establish how ownership on other rights in CBDC can be transferred between economic agents. This is, to conclude, the reason why we consider at the Haut Committee it is important to have, at least under the French law, clarification of the concept of money. And if it can help other jurisdictions with this report, we will be more than happy to share with you. Thank you, Mr. Chairman.
Thank you very much, Mr. de Vauplan, Professor de Vauplan, for this very interesting presentation, showing how many questions already one can raise in 5 minutes, but also what the challenges are. And I think it's a good start with our next speaker, because Evelyn Whitlocks will continue and present the ECB's work on the digital euro. And she is the program director in charge of the digital euro project at the ECB, and she has extensive managerial experience in the payment industry, amongst others as global head of payments with ING and general director products and innovation with Equens Worldline. She has been a board member of both European Payment Council and the European Automated Clearinghouse Association. And therefore, of course, she is very well placed to try to explain to, I mean, not to try to explain to us where we are heading to with this digital euro, what are the benefits, the design features, and so on. So Evelyn Whitlocks, you have the floor.
Thank you very much. Thank you very much also for inviting me to speak and to join this event. And since the event is about the future of money, it's indeed very good that we are also able to tell something about the digital euro, because we believe that the digital euro is, to put it very simple, an evolution of central bank money as we have it, of cash. But I have more to say on the digital euro than only that. So before getting into what the digital euro would be and how it would work, let me remind us of 3 key factors that we see today in the payment sector in Europe that influence also the thinking behind the introduction of a digital euro. So first of all, we see a steady decline in the use of cash. So in only 3 years' time, we saw the proportion of cash payments falling from 72% to 59% in the Eurozone. But for example, if you look to the country where I'm coming from in the Netherlands, only 1 in 5 transactions is still paid by cash. And what we also see is that in 2023, for the first time in history, actually, not in history, but in recent history, the number of banknotes in circulation decreased. Secondly, if we look to Europe, we see that there is currently not a single European payment solution for digital payments. So where with a banknote, you can travel across Europe and you can trust that you can pay everywhere. With digital means of payment, this is not the case. So if you travel from one country to the other, be it in store or online, quite often the payment method that you use is not accepted. And then if we do see payment solutions that are actually covering large part of the use cases in large part of Europe, we de facto rely on international providers. So currently only 7 countries among 20 in the Euro area have a national card scheme. So that means that 13 countries rely on these schemes. And as a result, roughly 2/3 of our payments are initiated payments from cards. So in this context, we believe the digital euro would be the next step in the development of our currency. So what would a digital euro be? And I'm not going as deep into the legal explanation as the previous speaker. But for us, it's important that it's not a cryptocurrency. Actually, we believe that most of the cryptocurrencies are a crypto asset more than a currency. But the digital euro would be a digital retail means of payment, which is issued by the ECB and would be available for all people and all businesses for a selected number of retail payment scenarios in the entire euro area, wherever digital payments are accepted. A digital euro would make the life of the euro area citizens people easier because it would offer them more freedom of choice, and they would be able to pay with a secure solution that is widely accepted throughout the entire euro area. And it would therefore be a complement, not replacing, but a complement to euro banknotes, which of course continue to be available. If we think about the digital euro, of course, in order to be successful, we need to bring value to its users, and the users are both consumers and merchants. The current plan is that we would support, when at least at the start, 3 use cases. That is peer-to-peer payments, it's point of sale, so in-store payments, but also e-commerce payments. The users would be able to do these transactions with electronic devices as smartphones and physical cards or via a web face. What's important, the digital euro would be available both online but also offline. So that would allow you to have an experience as close to cash, also on the with related to privacy. If we look further on the role of the PSPs, we believe that they play a key role in the design of the digital euro. So the digital euro will be distributed via them. And next to that, we have made sure that in our design, we safeguard financial stability, and we have incorporated a couple of elements in our design to secure this. For example, this is holding limits, but also, for example, the fact that the digital euro would not be remunerated. On top of that, we believe the digital euro would be a platform for innovation and would allow really the rise of further pan-European payment solutions. Before I close, a few last words on the next steps. So we have finalized the investigation phase, which focused very much on the design, and currently we are in the preparation phase, where we focus on finalization of the scheme and starting with the search of potential provider. It's important to note that the digital euro evolves in parallel with the legislative process, which is currently ongoing, and we very much welcome this democratic debate and stand ready to provide technical support. And of course, we will make sure that we adhere to the final legislation once it comes there. And we have committed that we will not issue a digital euro before this legislation has been adopted. And with that, I would like to close and thank you for your attention.
Thank you very much, Ms. Whitlocks, for these very clear indications. It is really indeed rejoicing to see that the European Central Bank is beginning with the design first, with some safeguards as well, and we might come back to that in the discussion to see exactly how this will work. Thank you very much again. We should have gone now to the CBDC and with Kim Jørgensen, Director General of the European Investment Bank. Unfortunately, he had a problem with connection. He couldn't connect, and we tried everything we could. And apparently, this was not possible. And therefore, we will have to come back to understand how the CBDC will be implemented by the EIBs, but maybe some people may also complement that during the Q&A. So let's continue, therefore, directly with market regulation and with Mr. Denis Baux. He's the appointed Deputy Governor of the Banque de France in August 2017, and he was reappointed. Now it's okay. And he was reappointed as first deputy governor in January 2024. He chairs the Autorité de contrôle prudentiel et de résolution and the Observatory for the Security of Payment means. And he's also on the board of the IMF and the supervisory board of the European Central Bank. Since joining the Banque de France in 1986, he has held various roles, including serving as Deputy Director General of Economics and International Relations. And now I'm thrilled to hear what the Banque de France and Frank's work on CBDC will do, and maybe that will also help us to understand exactly how CBDCs will work if they will, and what are the challenges? Mr. Denibaud, you have the floor. Thank you.
Thank you, President. I hope you can hear me well. Good evening. Can you hear me?
Yes, we can hear you. It's very loud, but we can hear you.
Sorry, I'll try to adjust my mic better. Thanks. I'd like to start by thanking the LI for inviting me to this panel discussion on the future of money. I'm very pleased to share with you a few thoughts on the challenges which have emerged in the field of money and the associated payment system as I see them from my French central bank and supervisor standpoint, and on the policies we develop given our monetary and financial stability mandates to help address them. On those topics, within the 5 minutes or so I have, would like to make 4 quick points. The first one is on the changes which are taking place in our payment system and the wider financial system, driven by the advancing digitalization of financial services. At this stage, a lot of attention is focused on the use of DLTs in relation to the speculative crypto market and decentralized finance. However, behind the hype, there is a more discrete and more transformative trend underway, the tokenization of finance. It could lead to far-reaching changes in the way our financial system operates by fostering the emergence of new players that bridge the gap between IT and finance, new investment and settlement assets in tokenized form, and new type of financial infrastructures decentralized based on DLT, particularly blockchain. My second point is about the opportunities and risks created by those transformations for market participants and the payment system as a whole. Here, I would like to stress first that this impact is likely to be two-sided. To illustrate this for the functioning of the payment system, it is important to recognize that the positive impact those transformations may have in terms of improved transparency, better cost effectiveness, and round-the-clock availability could come at the price of more fragmented processes. This is particularly relevant if blockchains are not interoperable and unable to interact smoothly with existing central clearing, settlement, and payment system. It could also come at the cost of an excessive reliance on non-European entities, which raise competition, strategic autonomy, and data protection concerns. Second, this two-sided impact creates specific challenges for an institution like the Banque de France, given its mandate. A major one being the preservation of the critical role played by central bank money in anchoring the stability of our payment and of our financial system more broadly. In that context, we see our task as being to help mitigate the risk brought by the transformation underway, while ensuring that benefits of the transformation are harnessed. To deliver on that task, we intend to use, and we have actually started to use, 2 policy instruments as levers on the basis of 2 convictions. The 2 levers are our influence in the development of regulations for payment services and system, and the adaptation of our central bank money services. The 2 convictions are first that innovation can bring sustainable benefits for the payment system only if it benefits from the confidence of its users, which requires a regulatory framework that does not stifle innovation, but that is sufficiently demanding to ensure the protection of the stakeholders and the stability of the system. Second, There is a public interest in keeping central bank money at the heart of the settlement processes between financial intermediaries, as it is the safest settlement asset and hence the most appropriate to ensure financial stability. My third point is about the use of our policy lever, the contribution to the development of regulation. In this field, we have in the recent past contributed to the trail blazed in France in crypto assets with the adoption in May 2019 of the PAC law, which introduced the legal status of digital asset service providers. Europe's lawmakers have drawn heavily on the French framework with the adoption of MiCA regulation. Looking forward, while MiCA represents a vital regulatory step forward, it will need to be built on in the coming years. For example, it only partially tackles the concentration of crypto asset services activities within crypto conglomerates. By virtue of its decentralized nature, the DeFi ecosystem likewise raises regulatory challenges that will need to be addressed. With this in mind, the ACPR has begun identifying potential avenues of regulation. They were set out in a paper published in October 2023. They include 3 measures, but I don't have the time to develop them. You can find them in the paper published by the ACPR. My fourth and last point is about the use of our second lever, the adaptation of the services we provide in central bank money. It has taken the form so far of 2 major endeavors to prepare for such adaptation. First, the Banque de France was the first central bank to launch an ambitious experimental program on wholesale central bank digital currency, CBDC, for large value payments in 2020 to support DVP and PVP settlement processes of tokenized financial assets, both domestically and cross-border. The experiments are now pursued under the aegis of the ECB. The Banque de France wholesale CBDC technical solution, based on our own DLT, is one of the solutions currently trialed by the Eurosystem, with 19 trials of our solution foreseen in the coming 7 months. The Banque de France is also taking part in several important international initiatives, notably those spearheaded by the BIS innovation hubs to explore the future of market infrastructures and interoperability between traditional systems and different types of DLTs. The second major endeavor is our participation as a central bank of the EU system to the preparation of the digital euro. But I do not develop this aspect as my colleague of the ECB has told you a lot about what it implies. If and when we will deploy those CBDCs, wholesale and retail remains uncertain as we speak. The only certainty we have and market participants should have is that we will be ready to deploy them if and when we deem it necessary to meet our policy objectives in line with our mandate. So let me stop there. Thanks for your attention.
Thank you very much. I have to say I didn't know that the Banque de France was so in advance of its time, and that's quite impressive. And I'm sure we will be able to come back in the discussion about these various experiments since 2020 and see how things evolved. I suggest that we continue now with Sir John Cunliffe. He is a senior policy advisor at Rock Creek Global Advisors, focusing on macroeconomic and financial regulatory policy. And he was deputy governor at the Bank of England, overseeing financial stability, clearinghouses, payment system, etc., and especially also digital assets, and led the Bank of England's digital pound project. He served on the financial policy, monetary policy, and prudential regulation committees, and from 2019 to 23, he served as chair of the Bank for International Settlements Committee on Payments and Market Infrastructure. Previously, he was also the UK permanent representative to the EU and an economic advisor to the Prime Ministers David Cameron and Gordon Brown. Knighted in 2010, he holds a degree in English literature from the University of Manchester, and therefore literature can even bring to the highest position in economic and banking system, which is fantastic. And he will tell us all about the digital pound and associated market regulatory challenges. Sir Cunliffe, you have the floor. You are muted, sorry.
That's better. Okay, you can hear me now. Look, thank you very much. Thanks for the invitation and the chance to talk about these issues. I'd only say that a qualification in literature just shows that the UK still believes in amateurs in professional sport. Look, the Bank of England consulted. I'll talk about retail CBDC, not wholesale, because the bank is doing things on wholesale as well. But the bank consulted on a proposal for the digital pound, retail CBDC, as Evelyn has described it, for general purpose use by citizens in February 23. It didn't consult on a decision to introduce one. It consulted on the model of a design to be worked up to a blueprint on which a decision could be taken. The consultation closed and the responses were published in February of this year, and I'll go into those in a little bit of detail later on. Why did the bank go forward with this? Two main motivations. One, the decline of cash, which Evelyn has talked about, and also the growth of new forms of money that offer the possibility of greater automation of money, greater programmability of money, and you could say greater functionality of money through the tokenization technologies that have been developed in the crypto world, and the central bank's concern about preserving the singleness of money in the UK, particularly when new entrants, new players started to come in to introduce new forms of money. And the second motivation was not really a central bank motivation, but more a general government motivation, was to ensure that we had competition and innovation in the provision of payment services, particularly if they were using these new tokenization techniques and exploiting the new functionalities. So the model that was proposed was a so-called platform model in which the central bank operates the ledger and holds the individual accounts, but it's private entities who interact with the account holders, the end users. They provide the wallets, they provide the payment services, and they are actually the channel between the end user and the central bank ledger, and the end user sends its instructions through the private sector entities. We call them PIPs, payment interface providers. And that model is very important from a legal point of view, and I'll come back to it. I'll say a quick word about the response to the consultation. We've got 50,000 responses, which is more than the Bank of England has ever had for a consultation. The majority didn't answer the question, what do you think of this model? They basically expressed three broad societal concerns: privacy, will the central bank and government know what I'm spending money on? Programmability, will the central bank or government be able to stop my money being spent on certain things? And cash, is this a way of getting rid of cash so that I'll have no option but to use this central bank money? The responses on the model were more detailed and were generally more supportive. And the bank is now in a design phase to work up the blueprint, expecting that a decision will be taken probably in around 2 years' time. So I'll turn quickly to some of the key legal issues and link that back to the consultation. So the government has now made clear it will introduce primary legislation before any central bank digital currency is introduced. It hasn't scoped out that legislation yet, but the expectation is that will deal with, address the issues that Hubert raised about the authority of the central bank to issue a digital currency, questions around legal tender, finality of settlement, finality of transaction. I'm not sure it will have a definition, a legal definition of money. It may, as we do now, define money by the things it is used for, rather than as a thing in itself. It will also probably have to address competition law issues about the central bank competing with private sector payment systems. But that legislation the government has committed will also address questions of privacy, ensuring that privacy is protected, and questions of programmability, because the government has declared that it will not program a CBDC if one is introduced. And I'll concentrate on those last two things, programmability and privacy. On privacy, it's worth using a set of distinctions I think developed in the BIS. So privacy means that an entity has information, but is precluded by law from using it or from revealing it, except in certain defined circumstances, tax avoidance, illicit financing. Anonymity means the entity has no information about the user and what the user does. And then the last definition is a new one, which is pseudo-anonymity, which means the entity does have information, but it cannot link that information to an actual individual. And if you think about it, banks at the moment operate privacy. They have all the information, but there are constraints about them revealing it. Cash is anonymous. No information passes hands when a banknote passes hands. Pseudo-anonymity is a concept, I think, that will be important to the platform CBDC. So in the Bank of England's conception, the private sector entities, the PIPs, would offer privacy. They'd have information which could be linked to individuals, but they couldn't reveal it except under certain conditions. The central bank would have pseudo anonymity. It would have some information, but it would not be able to link that information to individuals. And by the same token, programmability would be done, because the central bank would operate the ledger, but that would not be a programmable ledger. It would simply take instructions from the private sector entities on making transfers of value between pseudo-anonymous accounts. The programmability would be with the private sector entity, and thus governments would not be able to prevent you spending your money on things they didn't want you to spend your money on. And finally, on the regulation of PIPs, because these payment interface providers will not be issuing a debt claim on themselves, like a bank, they will not need the prudential regulation that we apply to banks to make sure banks can actually meet their liabilities. And because they will just be passing a message, they will not, we think, be holding the asset, holding money. And I know there's been a really big discussion in UNIDRA and the UK Law Commission on how you define holding a virtual asset that has no physical presence. But if the intermediary has no control of that asset and is a channel for just passing the message, then I think the view is it would not be a holder. The holder would remain the end user, provided you can ensure that the end user retains control of its of the cryptographic keys that give access to the account. And there are a number of technical projects around as to how that might work. And the consequence, I think, is the regulation of the payment interface providers, the private sector entities, can be limited to anti-money laundering, counter-terrorist financing, operational resilience, proper governance, and arrangements for what happens in failure. That's a much lower regulatory hurdle than we have for banks and custodians at the moment. And the aim, that links to my original motivation, the aim is then to make it much easier for new players to come into the market and to have innovation and competition, so that people are competing in the provision of payment services and not competing in the issuance of money. I'll stop there. Thank you.
Thank you very much. Very interesting again. And I'm sure we will come back on these various aspects. You were very clear also, Sir John, on for instance, the programmability, which is a really important concern. So I suggest that we will continue now, and after France and England, or United Kingdom, to be more precise, let's go to Italy with Francesca Provini. She graduated in economics and commerce at the University of La Sapienza in Rome, and started to work at the Bank of Italy, where she was involved in the main important reforms of the whole payment system, including SEPA and dematerialized checks, and more innovative component tied to the digitalization of the industry. In 2020, she was appointed head of the Payment Instrument and Service Division, and she now coordinates the activities of the Italian Payment Committee and participates to national and international working groups, among others, of course, also the Oversight Working Group of the Eurosystem and the EBA's Standing Committee on Payment Services. And so we are really thrilled also to listen to you, Francesca Provini, to see what happened in Italy with the CBDC and where you are in your reflections. Thank you.
Thank you. Can you hear me?
Yes, very well. Perfect.
Okay, thank you. First of all, thank you for inviting me today. And as Ms. Whitlock's already said, in recent years, we have experienced a deep transformation that is still ongoing in the retail payments area. Although, for example, in Italy, we are still significantly used to make purchases in stores with cash, especially for small amounts, it is clear that thanks to technological developments and also to the impetus we received from the restrictions due to the containment of the COVID pandemic, the trend in payment habits has changed. We observe a very, very substantial growth in payment cards, both debit and credit, but there are also signs of growth among more innovative tools, such as, for example, payments wallet issued by the so-called big tech. And in the future, as someone said before, we could also imagine that the use of crypto assets for making payments, and I have in mind the stable coins as regulated by MiCAR, will probably grow. In such a scenario, central banks must then reflect on how adapt their instruments to the challenges that this kind of ever-changing social and technological environment imposes. And for these reasons, the Eurosystem has launched the project aimed at exploring the possible issuance of a digital euro. A project like the digital euro, given its political, economic, and geographic, and also social scope, presents, in our view, different aspects of delicacy. And one of these is that related to the involvement of all possible stakeholders, stakeholders that includes subjects ranging from supervised intermediaries to consumers, to merchants and businesses, and last but not least, to public administrations. All these actors are called together with the Eurosystem and with the co-legislators to produce in the future and from now on a significant collective effort for the success of the project. In this context, the Eurosystem, and aware about this, the Eurosystem conceived a very specific framework to involve all these subjects through different fora, some open to, how can I say, broader groups, such as the Euro Retail Payment Board and the Rulebook Development Group, and others that are more restricted. For example, the Market Advisory Group that was activated during the investigation phase to collect inputs from supply-side market experts. And in this framework, we think that it is important for national central banks that are able to leverage their in deep their knowledge of individual markets, and that are also aware of the specificity of local environment, to engage with national stakeholders to decline, to pass the key messages of the project and to establish a fruitful dialogue. In Italy, coming to Italy, in Italy for some years now, the Bank of Italy has established the Italian Payment Committee. In Italiano, we call it Comitato Pagamenti Italia, which has always been a point of reference for operators as a forum for discussion in which the strategic lines of the evolution of the national retail payment market are outlined, and relevant decisions are often taken at the system level. And in this context, a number of specific working groups have been activated with ongoing experiences that have proven to be very, very positive. And in this context, we are considering the establishment of an ad hoc work stream to collect market requests, expectations, also doubt related to the project of the digital euro. In particular, in our mind, the working group could develop reflections that can support the Italian delegation in the activities related to the negotiation of the digital euro legislative proposal, could also analyze the impacts that the project will produce on payment service providers, having in mind financial, organization, and also business model aspects. And attention may also be paid to the impacts on other stakeholders, I mean citizens, businesses, and public administrations, to raise, in this case, to raise their awareness about the characteristics of the digital euro and also about its future and potential benefits. So we believe that in this way, synergies could be developed among different players. The awareness of the system may grow, and at the time of the eventual issuance of the digital euro, everyone can do his job, can contribute to the success of the project. And I stop there, and thank you for your attention.
Thank you very much, Ms. Provini, for this presentation, and also for underlying a very important point, which is information of the public, which is central for, of course, as you said, the stakeholders, and then also the implementation of the digital euro when it will come. I think that that's certainly important, and we will come back on that in a moment. But first, let's get a bit deeper into CBDC and the issue of fundamental rights, a kind of human approach to public monetary management, with Marko Dimitrijevic. He's associate professor at the Faculty of Law, University of Niš in Serbia, and chair for law and economics, and Jean Monnet, a module for European monetary law academic coordinator. His field of teaching include European international monetary law, economic policy for lawyers, and the law of economic system of the EU. He has been an observer of the European Law Institute and an international research fellow at the Information Society Law Center at Cesarea Beccaria Department of Law, University of Milano. And he worked in many places to think about the interaction between this economical aspect and also fundamental rights. And so I'm thrilled really to listen to you, Professor Dimitrijevic. What you have to say about this CBDC? Are fundamental rights really in peril, in danger with the CBDC? You have the floor.
Professor, thank you very much for this kind introduction. It is my great honor and pleasure to be able to participate in this webinar today, and I'm quite thankful for this opportunity to share some thought and to learn about the future of money from such respectful participants. When we speak about that human approach in public monetary law management, it looks that it is actually based on the fact that today almost every monetary measures and actions has some influence on constitutional and fundamental right, especially in the context of the quality of the life of the people who live under the state, where we can see that implementation of primary and secondary monetary legislation. I like to call that people monetary habitants. And you know, beside monetary law as positive and independent branch of law today, we also have that monetary rights. We can understand monetary rights as sui generis, sophisticated social and economic right, which actually refer to right to have solid, firm, and healthy currency. And this is quite important, especially in smaller economy, which actually have the trouble in maintaining price stability and erosion of monetary credibility in the past. Also, this aspect is very connected with the rule of law, which is very important principle in central bank management today. And you know, it looks that this principle skillfully avoided to be involved in some precise definition, which are actually ad infinitum, which will embrace all its meaning in academia and in practice. And that is actually quite good because it provides enough maneuver space for a central bank to maybe, you know, fulfill certain gaps. And also it is reflection of one very important concept in international monetary law today. It is humankind concern concept, which actually emphasize the need for that cooperation between central bank at global level, of course, in order to provide some sustainable condition for fulfilling monetary stability as global public good, if I may say that. And of course, CBDC is par excellence example of some monetary and financial innovation. We have a lot of monetary innovation in monetary history. Some of them are relics of the past, some are not. And you know, this issue with exploring CBDC is actually provoked by massive popularity of private digital money. In the case of private digital money and the use of decentralized financial technology, if I may share one thought, maybe we can see that other side, which actually speak about the monetary sovereignty nature. It is not only an integral part of political sovereignty beside fiscal and financial. It is actually something quite important for the human being, because in the case of private digital money, there is actually a raise of monetary sovereignty in human being itself. It is important because it is something which actually provoked central bank to explore the issue about central bank digital currency. And it is a solid proof that central bank actually listen and respect the will of people. I believe that it is important, especially in smaller economy, because, you know, we expect so much from the central bank and its work is not panacea. Sometimes its work is actually far away and complex from people everyday need. But, you know, this is a solid proof that central bank is also bank who act for the people, bank for the people. And in that case, in international monetary law studies, we can actually read and hear a lot about one very important tendencies. We can call that tendencies lex moneta or lex financiera cryptographica, which refer to policy mix beside, which include actually soft and hard monetary legislation, which will be enacted at all level of government in order, you know, to fulfill that monetary stability. In the structure of this tendency, we have two agendas. The first one is bottom to up, and we already have that in the case of private digital money. But what we're missing is that up to bottom agenda, which refer to CBDC. And in that synergy approach, in that public-private partnership, maybe we can, you know, provide some condition for implementation of that monetary rights in full sense of the word. Also, we must be aware that in legal regulation of CBDC, it is very important to provide some optimal legal framework, which will thwart technocracy, which will escape that partial interoperability with limited cooperation, and which will be actually quite useful in order to provide central bank the position of the monetary sovereignty keeper and holder at one place, but also to maybe confirm its position as a monetary innovator. In monetary law theory, there is also one very beautiful analogy which speak about transition from Copernican era era, where everything was rounded over the sun. And of course, that sun is just euphemism for the golden standard, to Einstein era universal relativity, where we actually have innovation in the core. And that was electronic money in the past, but nowadays that is actually the digital money. Thank you so much for your attention. It is my great pleasure to share some thought and to listen all your presentation about CBDC. Thank you so much, Professor.
Thank you very much. And indeed, with even four major central bank representatives here around the table, if I may say so, there's a lot also about innovation, and we will come back to that in a minute. But first, you spoke also about Bank for the People, so let's have the people speak. And I have Anna Martin here with us. She's Financial Services Officer at BEUC, the European Consumer Organization in Europe. And she's in charge of retail banking, working among other files on payment services, access and acceptance of cash. And you see that, of course, this is a major issue in some countries. The issue about whether cash could be constituted as a fundamental right inscribed in the Constitution has appeared. And Anna Martin will certainly have something to say about that. I will not extend. I give you the floor. Thank you very much for being with us today.
Thank you very much. And that would have been exactly what I would have started with, that speaking about the future of money, my first key message is that cash is here to stay. Because we are speaking about payments, which is really an essential service to society. You're not accessing energy, you're not accessing food, you're not accessing public transport if you don't have a means to pay. So that's really my key message, that we need to cater to have a payment solution which is working for consumers. And cash is currently the method which works for everyone. Whether you're old, whether you have a disability, whether you're an asylum seeker who is not having access yet to a payment account, whether you want to use cash to manage your budget or because you want to stay private, it's really the payment method which works for everyone. But of course, we are also looking into a future. And we also see that cash is not working everywhere. Even though it's working for everyone, it's not working everywhere. And we do see that we need a solution working as a public good, which is also working in the internet. And being able to purchase online with a public means of payment. And that's where we very welcome the digital euro as a payment solution. Because when we go online, we do not have a public means of payment currently. And as a consumer organization and representing consumers, we do see many problems with this. Evelyn has mentioned several of them, but I will come back to them. We do not have a payment method which is working everywhere. When we think about the national card schemes, as soon as you go online, as soon as you go in another country, very often they are not working. And we see this trend actually reinforcing with the abolishment, for instance, of maestro functions. So as of, I think, 2027, when you go abroad with your German Giro card, it's basically useless because you cannot use it anymore because it's not supported as a payment method in other European countries. And very quickly then as a consumer, you are left with two options, either MasterCard or Visa, and none of them is a European solution. And it's a very basic question. If we as the European Union really want to be left with two international card schemes which are non-European. So that's the first point on the general acceptance. But there are also other points. Not having a public means of payment means also that you, as a consumer, you don't have a means of payment which is really built in your interest, in the general interest of society. And there are many, many things which come to mind. And I'm coming back to where I started with the cash, which is the aspect of inclusion. cash, I remember, I mean, I was still very small at that time, but when you introduced the euro, there was a lot of discussions, for instance, on how are the banknotes and the coins designed that blind people can use them. We have very similar discussions now in the rulebook on how is an authentication method with the digital euro working for people with disabilities and or people who have a bit older and have difficulties to work with online interfaces designed by private payment means. So these are these kind of discussions we are currently having with the digital euro. I haven't seen them happening with private means of payments before. So this is something which is very important, and where we value very much the digital euro. The same discussion when it comes to privacy. We are thinking now about an offline solution for the digital euro, which doesn't trace our transactions. For consumers, that's very interesting also in a wider framework of discussion on open banking, open finance, where as consumer, you're more and more pushed to share all your payment data, all your financial data with third parties. But don't we need perhaps a safe space where we can do all the payments we don't want to share with all sorts of third parties? And there is, again, a good space where the digital euro will come in. You have a solution where you go to the doctor and you pay. It's not on your track record, and the next credit scoring is asking, why are you going 3 times a week to the doctor? These are the questions which come from a consumer perspective, and where privacy matters very much for payments. So these are the kind of topics and discussions we are bringing into this digital euro discussion. Also, of course, the question of costs. If we are left with a duopoly of 2 international card schemes, who is determining the cost of payments for consumers and merchants? Don't we need perhaps this public competition coming in to have a competitive payment sector at the European level? So these are I will wrap it up here, but to bring in quite some food for thought.
Thank you very much for all these questions. Indeed, there are a lot of questions we can continue discussing in the Q&A session. Thank you to all the panelists. We got a couple of questions, and of course I have also a couple of questions, and you might also want to react to what one another said during the presentation. And maybe because we got 2 questions linked to this issue of tax evasion, which seems to be a central element of concern. So maybe we will begin with that, because in your presentations, both Evelyn and also Sir John, in fact, you mentioned, and others as well, you mentioned the pseudo-anonymization, first of all, and you mentioned also the PIP problematic. And is there not a risk indeed that the anonymization or pseudo-anonymization will have an impact on tax evasion with an euro on the Eurozone on the one hand, and also in the UK, what would be the risk, in fact, if you are not, if you are just as a central bank having the ledger, the DLT technology, but having no impact of really what's going on? Are then the intermediaries, in fact, the PIPs, the one that may be problematic in asserting that there's either no tax evasion or money laundering, because these are, of course, the 2 main concerns we can see. Maybe, I don't know whether Evelyn Whitlock, you want to begin.
Yeah, maybe let me go first. So, and also let me clarify that the level of privacy and also what AML CFT controls need to be there, in the end need to be laid down in the legislation. But let me refer to what the current draft legislation for the digital euro says. So it makes a distinction between the offline and the online digital euro. So for the online digital euro, the banks would know all your information as they know today on the on digital payments, and they are obliged to do all AML CFT controls that they are doing as they are currently doing for digital payments. The topic on pseudo anonymization, as was mentioned by John Conliffe, is actually referring to the part after, because if it goes from your bank and you need to pay somebody at another bank, it goes via the systems of the central bank. And what will happen is that the bank will anonymize this for us as a central bank. So we can just do the settlement without knowing who is who, but the banks will be responsible for doing any all transaction related controls. For offline, it's slightly different, as Anna also said a bit about, is there we would know, like with cash, or not we, but the bank would know that you put 20 euros or something on your online digital, offline digital euro. But once you pay, it moves hands like with cash. There is some safeguards there because it's always need to be proximity payments. So it's not with tax evasion that might be a bit cumbersome to do that, to be always in proximity. And the amount of digital euros you can hold on an offline digital euro device will probably be kept as well. So those are the safeguards that are currently foreseen in the draft legislation.
Thank you very much. So John, you mentioned that privacy was a high level question, so maybe you want also to react to
There's only a little to add. So one is trying to replicate some of the functionality of cash, but if you make very large frictionless anonymous payments possible, then of course you have problems with tax evasion and illicit financing. So cash at least has got some physical limitations. You have to carry large amounts around in suitcases, even if you get sort of large denomination notes. So the idea is, in the same way as banks today have responsibilities under to prevent money laundering, tax evasion, as Evelyn has said, banks, and in the UK system, because we envisage the payment system providers may be banks, but they may not be, but the PIPs will have those responsibilities, and that's what I meant, that they will be regulated to ensure they can do that, and they are doing that. The pseudo-anonymity, as Evelyn said, is there to protect the individual from the state in the form of the government or the central bank, knowing who is transacting with whom and doing for what. So we will know that a transaction has moved from account A to account B, but we won't know who owns those accounts. As for offline, I think what Evelyn has described is pretty much what happens at the moment for physical cash. If you try and use physical cash for large amounts to buy a house or a car or whatever, people will ask you what's for details of your identity. So capping the amount of CBDC you can hold on an offline device, requiring information to be passed about what you're holding, etc., is no different to what happens at present. And again, we envisage that would be done by the private sector entity, not being done by the government. So it's trying to get as close to the current system as we can in the prevention, in the protection of people's rights.
Thank you very much. This is very clear. Thank you to both of you. I was wondering, and I see further questions. I was wondering about the role of central banks, because of course their role is very central in keeping the economy going forward and so on, in ensuring their confidence. So how this could really be effective on the one hand, because you have innovation kicking in, and at the same time, as was mentioned by Denis Beau, you need your own DLT, you need to have your own system. What is the impact on the global availability of cryptocurrencies and the risk of volatility? I don't know whether, Denis Beau, you want to react on that, because you said you had some tests since 2020, and what are the risks in terms of your impact on the economy and your leverage as you have now, and Will it be more difficult with CBDCs?
Well, I mean, in terms of role of the central bank as we see it, given, I mean, innovation going on and the development of crypto assets, our view is that our role, given our mandate of monetary and to ensure our monetary and financial stability, is to make sure that in a tokenized world or part of a world where part of the assets are tokenized, central bank money remains available to be used, I mean, in the processes that will be at play in this tokenized ecosystem. Hence, all the experiments we have been developing, in particular, what between financial intermediaries, to make sure that when the settlement comes, the central bank money is available on DLTs in particular. So we see a role not as a positive one to contribute to maintain financial stability in providing central bank money as the preferred settlement asset between financial intermediaries, even if, I mean, the financial system evolves towards, I mean, a functioning where tokenized assets become more present, if not dominant. So that's I would say, I mean, for the functioning of the financial system as a whole. In the retail sphere, I guess the objective remains the same, to keep central bank money available. I think here, I mean, it was well explained by my colleague from the ECB. I think what is happening is that an increasing part of our daily transaction is done in the digital sphere, on the internet. And I think what is important is that central bank money as a payment instrument remains available in that environment. It is available in the physical world very easily. You cannot use banknotes to pay on the internet. Hence the concept of developing with the digital euro, to take the European example of a digital banknote with all the attributes. And here again, should be a positive impact in ensuring freedom of choice of the citizens between the different payment instruments, and at the end, the availability of a public solution anchored in central bank money, among others. As far as we are concerned, we don't consider that the objective should be to replace private settlement instruments and settlement means, but to complement what is being developed for the digital economy, with an option for retail payments embedded in central bank money. I hope I answered your question.
Thank you very much. Yeah, sure. Thank you very much. While listening to Anne-Martine, I was just wondering, and maybe I have a direct question to Evelyn Whitlock. Will there be charges for using digital euro? Because of course, when one uses credit cards, you pay charges, or maybe the shop owner will have to pay charges. The dematerialization, does it bring new charges, and would it be a difference in paying in cash or in digital euro in that sense?
Let me give you two answers. So first of all, for the consumers, it would be free for basic use. So this is all according to the draft legislation that's currently on the table. So it says should be free for basic use, and in the draft legislation that also points out what that is. But roughly speaking, it means that you can open an account, that you can initiate a payment, that you can receive payments, and that you can fund and defund your account, and that you get a means to pay, so an app or something like that. On the other side, merchants will still can still be charged. But the current draft legislation does propose that there will be a cap to that, because there is also mandatory acceptance. So that means that merchants need to accept a digital euro if they accept a digital means of payment. And in order to protect these merchants, there is proposed in the current draft legislation that there would be a cap to make sure that they are not overcharged for that reason. So that's what's there. We do foresee that that there would be a compensation for the distributing PSPs by an intra-PSP fee that could be there. And last but not least, the Eurosystem will take care of its own cost, like we currently also do for banknotes. So with all that, we believe that it could be free for basic use for the citizens. The merchants could be charged with a competitive and low fee. And on the other hand, banks will get some compensation for distributing the digital euro.
Thank you very much. And there would be no difference, because there's a question between online and offline charges or in the use of euro. If I use it online or offline, does it has an impact on the charges, overall charges? Because once, of course, it's more anonymized. So I don't know.
No, so the idea would be so on the consumer side, it would be the same, so free for basic use. On the merchant side, you don't see any different dealing on online and offline in the draft legislation.
I see. Thank you very much. I would have a question to Hubert de Vauplan, because you said, okay, there's no definition of money in France. I'm sitting in Switzerland, I'm Swiss citizen, and we have in our legislation a definition of money. And we've heard also by others that maybe, I think it was Marko Dimitrievich who said, you know, definition might not be so important as long as we know for which uses that can be would you favor to have a definition or let's say a demarcation, what is money and what is not money in that sense, in order also to allocate these 10,000 cryptocurrencies that we currently know about, to decide what are official means of payment and settlement and what are not, or is it not necessary?
I think it is necessary, not only because it is better for legal reasoning, but I think it is better for understanding, in the sense that as of today, we have various meanings that have been added to the EU legislation. But at the end of the day, some are defined for specific topics, and some are defined for other topics. But we don't know exactly what is the definition, the common definition between all of them. Let me maybe illustrate this concept. First of all, in order to maybe continue the discussion previously, my understanding of the legal reasoning of digital euro is it should be, legally speaking, it should be as an electronic banknote. Not an electronic coin, but an electronic banknote. In the meaning that what happens for banknotes should happen for digital euro. Then we come to the legal definition, in the sense that if we know what is a digital euro, including on a pure civil law aspect, we will know what happens in case of transfer of digital euros. I said previously that UNIDROIT as HCCH consider it is important to clarify the situation of intermediaries when transferring a CBDC, because the legal question behind this question is, what is the legal regime of transfer? Are we talking about tangible, intangible? Are we talking about a legal claim or liability? It's not the same. And this is not a question of regulation, and maybe this is the point to be clarified. We don't need a regulation defining the digital euro. We need to clarify the legal definition in each jurisdiction about money, more exactly, money in the legal sense, what it is. Is it any difference? Let me again illustrate. If you go if you look about a draft paper from IMF concerning the legal aspect of the CBDCs, I think it is not yet published, but it has been discussed during the UNIDROIT workshops. Whether or not the CBDC is issued on a token-based or on a account-based, the legal definition and the legal regime will not be the same. If it is token-based, then for some people, not me, we should consider that the legal regime will follow the token itself, not the money representing the token, but the token. In the sense, it will be not a liability, but a claim. You see what I mean? And this is why we have interesting debate within those working group at UNIDROIT, HCCH, and others, because it depends on each jurisdiction first to define how do you qualify banknotes and coins. Are banknotes legal claim, again, whom, by the way, the central bank, or are they liability? And then the legal regime concerning ownership, concerning the transfer of ownership, concerning the liability of intermediaries, will follow this legal definition. This is why it is so important to define, not at the EU level, but in each jurisdiction, what a digital euro legally represents. I don't know if I am clear, but just to try to answer to your point.
Thank you very much. Very clear. And also, of course, the issue of whether you can have ownership on digital euro is another question. And some authors consider that choice of law might be also directly implemented within the CBDC, for instance, so that you would know exactly which law is applicable to a specific CBDC by the choice of law that is technically inherently within the token, if it's a token-based CBDC, for instance. Very interesting. Sir John, you wanted to react as well.
I just had one quick point, which is in the UK, we have legislation now on stablecoins, which goes to your question about how will you determine what can be used for payment, which defines digital settlement assets, and basically says that if you use this asset as a means of transaction, then it then falls under the following rules and the following legal regime. And the Bank of England has put out proposals for that legal regime. So it is possible to define by use, and I think this is what Professor Dimitrievich was saying, define something by the use it's put to, and then create the legal regime around that use. Whereas if you issue a stable coin for investment purposes, then it would fall under a different regime. So there are already attempts to try and create those boundaries between what can be used for certain purposes and what can't.
Thank you very much. Well, it is time to conclude. I would have a long list of questions, and we still have, and you have certainly all further points to make, but the time is over, so to say. So let me, in closing, just express my deepest gratitude to all the panelists, because I think it is important to reflect on that, to try to make it understandable to the people, what is going on and what are really at stake with this a new evolution and development that we are facing right now. And I think it was very clearly presented, and also the various positions will certainly help all the people attending this webinar also to better understand. So thank you for taking the time. Thank you also, of course, for everyone who attended this session, but also those who will watch the recording later on, because I think that's a great way also to celebrate the 13 years anniversary of the European Law Institute. I wish you all the best. Thank you very much for taking the time for being with us. And I look forward to meeting you again, maybe with crypto assets in my pocket. No, that will not be possible, but we will see how the future of money will look like. But at least you help us to think about it, and that was very valuable. Thank you very much. Enjoy the rest of your day.